Welcome to Inevitable Wealth from Liberty One Wealth Advisors, a conversation around financial decision-making and events around the globe. In the age of instant information, level heads can be hard to find. Our hosts, Jacky DiLeonardo and Jacky Petit-Homme, provide objective and relevant insights to help you parse the data and block out the noise as you build your wealth. As managing partners of Liberty One Wealth Advisors, Julian and Jacky look to empower you to develop an increased understanding of financial markets and how they impact you.
Hello, everyone. Welcome to our 5th episode of Inevitable Wealth. We're looking to clear the air, as always, around complex topics, misleading headlines, and the stuff that comes across your desk on the day-to-day. Of course, I'm Jacky Petit-Homme, and I am here with Jacky and DiLeonardo. Julian, how are you holding up today?
Good morning. Eagles are 3-0, so everything is going great. It's all positive over here. Nice.
Gotta love a good record. Happy September, by the way, everyone. If you are upset that the summer's over, I'm sorry. For those of you that are looking forward to pumpkin spiced everything, congratulations. We're finally here. I, for one, I'm enjoying the cooler weather. Julian, what side of the aisle do you land on here? Are you pro summer or are you pro fall?
Summer, big fan, but fall's the favorite. I think everybody comes back to the city. It's nice, good energy, especially when the teams are good. But just nice to have everyone back. Whereas August, it's like you're coming to the office and you feel like you're the only person on earth. Like it's an I Am Legend type scene. So it's great that everyone is back in the city and everyone's rolling in the right direction here.
Yeah, it's a good point. I would say that's one thing I did realize when I moved to Philly. It is 2 different cities between the summer and fall. Like everyone just is out once the season comes. So
yeah.
Well,
so definitely great to have everyone back.
Yeah, it's good. It's good to see the energy. But we're talking about insurance. It's September, National Insurance Awareness Month, and I thought we should take some time to talk about it. I know Julian's really excited because this is his favorite topic. But obviously I'm just joshing you. But Julian, let's just get into it. Let's try to keep this brief and concise. Broadly speaking, what role does insurance play in a financial plan?
Yes. So we have a few different topics today. We'll try or different types we'll cover. Try and keep it brief. Insurance is primarily about risk mitigation and management, right? It's transfer of risk from you and your family to the insurance company for a cost, right? So you pay your monthly health insurance, and then if there's an unexpected bill, you don't have to pay it 100% by yourself, right? So you're giving them a monthly payment to offset that risk for you and your family. Really, few main goals for insurance: estate planning, wealth preservation, long-term stability, peace of mind, and can be tax beneficial, right? We'll get to it, but initially, right, the goal for insurance, that the takeaway from this call, know what you're buying and why you're buying it. So we'll get into that. Jacky, what types are we focusing on today?
So we're going to talk about, as briefly as possible, life insurance, disability, right, both short and long, long-term care, and umbrella insurance, which is one I'm oddly passionate about, and I'll tell you why when we get there. A little teaser. So let's start first. Easy. Life insurance, right? Is what it sounds like. Insuring your family or business, right, is taken care of upon your passing. Life insurance is simple. You have a death benefit, and you pay premiums towards this insurance company. And if you pass, this death benefit is paid to the beneficiaries. So let's break it down real quick, Julian. If you can tell the folks who've never heard of life insurance, you never know who's listening out there, like what are the 2 basic types of life insurance we see out there today?
Two basic types. You have term insurance and whole life, right? So you may have heard about both of these. Term insurance is very simple. It's like a subscription with, let's say, a 20-year term. For 20 years, right, you are paying into that policy. They're typically very cost effective. And at the end of the term, right, it expires. It doesn't have a cash value. It essentially expires. You ideally line it up with when you need that insurance to end. For example, if your family has a mortgage that expires in 15 years, you would want at least a 15-year term to make sure it's paid off, right? And make sure everyone's covered. The second is whole life. Now, whole life, I'm not the biggest fan of, right? I think it has its uses, right, depending on the situation, but it is far oversold, right? So when we look at insurance, 99% of the time, Jacky and I will recommend term because it is cost effective and extremely efficient. You get a large benefit for a low payment, whereas whole life insurance tends to be really expensive. What someone will tell you when you buy whole life, and whole life does have a cash value, so it's like a hybrid investment and insurance product, right? It sounds really great. It's 2 in 1. And they'll tell you 99% of term insurance policies don't pay out. But that's a great thing because it means everybody is living, right? Everybody is continuing to exceed the term and live a long, happy life. Nobody's upset on their drive to work when they don't get in a car accident, right? It's not like, oh man, I didn't get to use my Geico, right? It's great that it doesn't pay out because people are living and enjoying their lives. So with whole life, always keep in mind why you're buying it and what the goal is. They are often sold more because the salesman receives a higher compensation, right? Quite frankly. So always know what you're buying, why you're buying it, and what the incentives are for who's proposing it to you. I could be a lot stronger on it, but I just
he's trying to be nice about it. But Julian is. I'll give some folks some context. First, also, when we speak about whole life, anything that isn't term, we're talking about term. So you might hear universal life, variable life, index universal life, right? There's a ton of different policies, but at the end of the day, they're all a whole life policy. And I would say the reason why Julian is stifling his passion against folks selling whole life is, at least once a quarter, we'll speak to someone who's 28, no children, no spouse, no mortgage, no obligations at all, and their buddy sold them like a whole life insurance policy, right? And of course, this individual did not know like why they bought it. They just were told that they need it and they bought it. And so Julian is basically getting some PTSD from those types of conversations.
Hey,
but
everybody knows a guy at Northwestern Mutual, and he just graduated college, and he's like, I have the greatest thing. If you don't understand it, don't buy it, right? Know what you're buying and why you're buying it. So whether it's New York Life, Northwestern Mutual, we've all heard these names before. Just let's be intentional about what we're trying to accomplish.
And there's nothing wrong with whole life, again, right? I'll be the good guy here because I see Julian getting riled up. There's nothing wrong with whole life, but you need to make an active decision on why, right? So we have families we serve. They say, listen, we know our kids are going to be independent and out of the house after 20 years, and the mortgage is going to be lower paid off, but we still want to leave a benefit for our kids. Perfectly fine. But as long as you made that intentional decision, right, and you understand that, then we're all on the same page and we can move forward. But we could talk about this all day. Let's move on to the next thing.
Yes, one additional. It can have different goals, right? Whether that's estate planning, you're looking for wealth preservation or tax planning. But again, for 99% of the families we serve, we recommend term. And if you're the 1%, right, there will be a very clear reason why, whether that's you're going to be above the estate tax minimum, which is you're going to pass with $26 million. So of course, if you're in that bucket, right, we want to make sure that we're being conscious of what estate taxes look like, or for the most part, focusing on long-term stability. Your income's really high, so we want to make sure that you have vehicles to maintain a tax-deferred growth. So your income's over $500,000. But generally, for most folks, right, I feel strongly, term, easy, right? Keep it simple. Just because it's complex doesn't mean it's right.
I like that.
Continuing.
Yeah, good. Moving along.
Simple
and
problems don't require complex solutions, right?
there it
Complex
is.
problems require simple solutions most of the time. Sorry,
Fair point.
go ahead.
This is fine. I'll and one last thing I forgot to touch on is employer-sponsored coverage, right? Those folks out there who might have life insurance coverage through their employer, right? So this is something you see a lot. Many of you out there have it. It's usually a multiplier in your income, right? 2x, 3x, 4x, 5x. And we get asked a lot, hey, should I just keep my employer coverage? Should I also tag on a private policy outside? Julian, what are your thoughts there?
I think there are really a few things to consider when you're looking at just going through your employer coverage. One, oftentimes the coverage is not enough, right? Typically, right, a general high-level recommendation that you would evaluate is you want 10 years of your income plus any debt, right? So if you have a mortgage, right, 10 years of your income plus your mortgage, for example, in terms of coverage. Now, 2 times your salary, 3 times your salary is not going to cover that, right? So you want to make sure you have more than that. 2, if something happens to your role, something happens to that policy, right? If you change jobs, then all of a sudden you're in flux, right? It's not clear how much coverage you have. Want to make sure nothing happens during that time period, right? But that's hard to do. 3, I think when you look at it, it's kind of like renting versus buying a home. If you have responsibilities, if you have people that you take care of, if you have essentially a high degree of steadiness in your life and you are, taking care of a lot of different things, you typically look at buying a home, right? You have 3 kids and you don't want to change rentals each year. If you're, 27, right, and things are a little bit different and you're comfortable renting year to year, doing these 1-year re-ups through your employer, then that works as well. But understanding what your goal is and how you're going about accomplishing it is very important. Jacky, what would you add to that?
Yeah, and what I would add too is, whatever you can max out at your employer coverage, most often than not, it's pennies on the dollar, right? Well, you could get 8x of your covered salary for $20 out of your paycheck. I mean, that is always good to add, but same thing based on, to echo what Julian said, you never know what your health is going to look like, or you never know what the next role will be, and if that coverage will be there 5 or 10 years from now. So back to our point, make sure that you're aware of that risk. Some folks opt to get policies outside of work, some folks don't. But as long as you're understanding of that risk exposure, that at the end of the day is really the point of having the conversation.
Yes. And new benefits season, right? Make sure you review. You can ask us, we can help. But it's very common, right, for everyone, and it's just powerful to just roll last year's benefits into this year, right?
Yeah.
Not quite making any adjustments at all, whether that's good or bad.
So let's move on. We've got disability insurance. And I'll we'll talk about disability, but really disability, keep it high level. Some folks, your income might be needed at different percentages, but on average, what we see in the marketplace is the goal is to cover 60 to 70% of your income during the disability period. So disability can be short-term, right, where it's just a matter of a few months up to a year, or disability can be long-term, which is a year or over, and it can last several years until retirement age. And the whole goal is, just like life insurance is to help replace your income upon your passing, disability is, hey, God forbid you have an illness or an injury and you're no longer able to work, right? Then something that will protect your income and have the ability to pay your bills and your financial obligations. So there is one stipulation we would like to tell folks, will highlight about the any occupation for his own occupation, because Julian was just explaining this to someone, I think it was just the other day, not too long ago. So Julian, if you could break that down for the folks listening.
Exactly. So I think there are 2 main types that you look at: any occupation versus own occupation. And it's very straightforward. If you are a surgeon or you have a specialized skill, right, you always want to make sure you have own occupation. right? So if you are a surgeon, for example, and something happens to your hands or you develop an illness and you can no longer do that role, right? You want to make sure that the insurance company doesn't say, hey, you can actually do any occupation. You could be a Walmart greeter. You could take a desk job, right? Because obviously a surgeon is more specialized, higher compensation, et cetera. So you want to have, in that case, own occupation, where your own occupation is covered as opposed to any occupation. So it all comes back to knowing what you're looking at, making sure you're buying the right one. And that is the straightforward, right, difference between the two, own versus any.
Yeah. And if I may add one more thing to think about as well, is the elimination period. So disability policy will have what's called an elimination period. And it can be sometimes 30 days, as short as 30 days, or I've seen the longest 180 days, right? 6 months. So when you are looking at these policies and evaluating, make sure you keep an eye on that as well, because like, financial planning 101, you should have that 3 to 6 months emergency fund on hand. So if you have a policy that has a 3-month elimination period, then okay, I've got an emergency fund that's going to cover me until this policy starts to pay benefits. So that's, I think, one thing you should definitely look at when you're looking at the disability policies.
Absolutely. I think next we have long-term care. So, Jacky, what is long-term care? When does it come into play?
So long-term care is in this event triggered, right, when someone can't perform 2 of the 6 activities of daily living, right, or ADLs for short. So that's bathing, eating, dressing, transferring, right, which is getting in and out of bed or a chair on your own, bathing, and continence, right, which is using the restroom. So according to longtermcare.gov, if someone turning 65 today has just under 70% chance of needing some type of long-term care service, this is something that's very prevalent and becoming more common in the country today. So it's a very high cost. The average nursing home care is about $7,000 in the country. But if you're in the Northeast like us, where cost of living is higher, in Pennsylvania, New Jersey, New York, it can easily be over 10,000. So, it's a very high cost. It's something difficult that the families we serve. And Julian, I don't think I could think of anyone who hasn't experienced some form of long-term care event with a loved one personally. It's very common.
Exactly.
There's kind of 3 different ways to kind of manage this risk, Julian. So let's list those off here.
Yeah, so we have self-funding, right? So that is having essentially a nest egg, assets that are defined for this purpose, right? The same way that you have a reserve fund in case you change jobs or anything like that, you have a set amount for this. And I think the most recent statistic I read was it's the average stay is in Pennsylvania is 2 years, and the average cost is $125,000 a year. So knowing that, right, you might want $200,000 to $250,000 on the sideline, right, for that, not invested in stocks, right, because you don't necessarily know when this is going to happen. So self-funding, of course, an option, but want to be intentional about going about that. Option 2 is insurance, right? So buying a policy, there are a lot of different types, and looking to offset the risk. It doesn't mean we need the most expensive policy to cover 100% of things. We could do something more cost effective and try and offset 50% of the cost, right? And make sure everything is streamlined from that perspective. So there are different ways to go about that. You want to know what type you're buying. For example, does it have a cost of living adjustment? Because if you buy something at age 50 and you don't use long-term care until age 75, 25 years of inflation have gone by, and your $7,000 benefit is going to be significantly less valuable, right, than $7,000 benefit plus inflation each year, especially given the higher inflationary environment. Last option, Medicaid. So this is a little more complex, and we could do a whole episode on it. but essentially spending down your other assets to cover costs until you qualify for Medicaid. It can get very hairy, right? You want to be very strategic and deliberate about how you do it, because if it goes wrong, of course, you have just spent down all of your assets. There's some protections in place to protect your spouse. You can keep some funds liquid and the primary residence is protected, but definitely speak to an expert prior to evaluating that one, or really any of them, in terms of what you're trying to accomplish. Any additions, Jacky?
Yeah, no, that was a great rundown, Julie. Nice and concise. Yeah, I would just reiterate, right? The Medicaid, there are it's called spousal impoverishment protections, where they do a calculation and there's a certain amount of assets your spouse can hold onto, right? And also the primary residence is typically protected as long as one of the spouses are living in the home, or if there's an intent to return to the home, if, heaven forbid, you're both in long-term care facility. However, each state has a couple different rules, and we always encourage individuals to speak with a specialist, and also your planner as well when you're analyzing all of these different options, because all these options, there's not a right or wrong. It's whatever you decide for what's right for yourself and your family. We've had families that we serve that have chosen all three of these options, right? So just understanding what your risk is, how you're going to mitigate it, or how you're going to address the risk. That's the whole point of having that as part of your planning conversation.
Exactly.
So let's see here. Last thing. Oh, umbrella insurance.
You love this one.
Yes. This, I know this isn't technically advice, but if you own a car, if you own a home, if you have a pet, if you have $1 in a bank account, go get umbrella insurance right now. Literally, after you listen to this call, listen to me. After you listen to this podcast, go get umbrella insurance. I'm very passionate about this, oddly. If you've spoken to me in the last 4 or 5 years, or if you've received any form of official recommendations page from me, it's all but guaranteed, unless you already had umbrella insurance, to have umbrella insurance. Namely, because the litigious society that we're in, you can get sued for anything, and an umbrella insurance is exactly what it sounds like, right? It's extended liability coverage. I will give you all, if I may, Julian, I don't know how we are on time, but I want to give the people my personal story so they know why I'm so passionate.
Let's hear it.
Okay, so once upon a time, past Jacky, back in 2018, received a letter, and this letter said, hey, you're being sued by such and such person because this person slipped on ice outside of your place. I lived in a condo, and there's 2 units in the building, so the condo association was getting sued. Now, I am someone who enjoys shoveling snow and everything, and I was like, hey, this is kind of wonky, but we'll see. So thankfully, our condo association had umbrella coverage, and the umbrella coverage paid for an attorney and paid for all the legal fees. Now, here's the rub. When the attorney did their homework, she's noticed that on the day that this person slipped on ice, air quoting ice, if you're not watching, it hadn't snowed in over a week. And the day it did snow, it wasn't even an inch of snow. And then the week after it snowed, it was over 50 degrees for a full week. Now, I am not a specialist in physics, right? But I'm pretty sure, yeah. Or I just mean that ice, if there was, the ice was gone, long gone. So even with this information that was proven evidence, right? The fact that the insurance agency just decides to pay out anyway, because if anyone who deals with insurance knows, they'll either just settle, give you a check and move on, than take it to court. So I, who pay $600 a year on $1 million of coverage, basically saved tens of thousands of dollars in that instance for something that was, in my opinion, a fraudulent lawsuit. So I am a huge, huge advocate for umbrella coverage. Like I said, if you have a dog, if your dog bites someone, they want to sue you, umbrella policy. If you have teens out there who are driving, they get in a car accident or something, someone wants to sue. I'm telling you, you all know these stories. Just mitigate the risk. Don't self-fund a lawsuit. Okay, get it. Okay, so I'm gonna step off my soapbox because I could feel myself talking about this for another 10 minutes, but your property and casualty provider probably has it. Tack it on, $600 a year. It will be, hopefully you never have to use it, but if you do, you'll be very happy that you did.
Exactly, right? So covered all the bases, very cost effective, right? So in this case, right, 50 a month, can be more, it can be less. But I know a lot of people spend a lot more on, salads or whatever it may be, right? So it's something that has high impact, cost effective, etc. I think action items, right? Takeaways, Jacky. One, from my perspective, know what you're buying and why you're buying it, right? If you're evaluating, looking at a policy or some sort of protection, know what it accomplishes and what your other options are. If it's not a good fit for you, that's great as well. But being educated on what the incomes and outcomes are of these policies and different tools are always best, right? Always best be intentional. Number two, protect yourself and your family. So if you're financially responsible for someone, that responsibility doesn't go away if you pass prematurely, right? So making sure that you have adequate coverage for whatever it may be, making sure that everyone is taken care of because it does happen, unfortunately, but you want to make sure you are covered. What would you add?
I would add two, to tack on about know what you're buying. Also, be intentional about what you're not buying, right? Back to the long-term care. There's some families that say, hey, listen, we're not going to buy this policy for X, Y, Z. We're going to self-fund or what have you. That is great, right? As long as you're making the intentional decision on what you're getting or what you're not getting and why. And then the second is, back to long-term care, I would review policies. If you bought a policy that was 5 or 10 years ago, double check it. Make sure it's still in line of what your needs are. With inertia today, we set up for this policy. It comes out your account automatically. You don't really think about it. Review the policies and also make sure other folks are aware that these policies exist, right? Whether it's your financial planner, whether it is your spouse, loved one, trusted contacts. But if heaven forbid something happens to you and there is a life insurance policy and no one knows that exists, I could almost all but guarantee that insurance company is not going to come finding you. So have a place where you have these policies. For families we serve, we ask them all the time, we'll hold on to your copies as well, but make sure that individuals are very aware of where these policies are and that they exist.
All right, perfect. We've gone probably a little long, so thank you if you're listening, driving to work, whatever it may be. Any question for us to let us know. Otherwise, have a great week whenever you listen to this. I mean, it might be a month from now, it might be tomorrow, on your time. But thanks for coming and have a great day.
Thanks, everybody. Have a good one.
Liberty One Wealth Advisors is a registered investment advisory firm located in the state of Pennsylvania. Any options expressed are derived from sources generally believed to be reliable and are provided for informational purposes only. It does not constitute any form of advice or recommendation to buy or sell any securities, adopt any investment strategy discussed, or invest in any specific product. Nothing contained in this podcast constitutes investment, legal, tax, or other advice, and is not to be relied on in making an investment or other decision.